I believe that AI is going to change my life dramatically. In fact, it already has. I have on our website, Best of Us Investors, a bot, a chat bot that I invite you to come to and ask any question. Well, I did it myself. I went to the bot and I asked it some questions about how is this banking crisis that I believe that is going to happen as a result of the vacancy rates that's happening in all the major office buildings in all of our major cities. How is that going to affect the stock market in the future as these banks have to foreclose on these buildings and take them onto their books and then write them down because they're vacant and there's no one in them? They have to go through a gentrification to turn them into potentially apartment buildings because of this coronavirus. Nobody's coming back to work, and those that are, they are fewer and they need less space. And so this is an issue. So I went to my chat GPT that's on my website, and I said, what is the situation? Who holds these mortgages? And what are the 4 banks that I should avoid because of the potential crash that this will occur, similar to the 2009 crash relative to the subprime crisis, but rather being in the 260 to $300 billion effect, that this is a $1 trillion problem that is going to hit our markets and bring our markets down before we can reap the benefits of AI. I also want to talk to you in the future about there might be something of an AI bubble that we have to deal with. But we'll talk about that another day. Right now, I want to introduce you to my AI avatar who will explain this succinctly and to the point so that you can know who are the 4 banks you need to avoid because of the coming commercial loan real estate crash.
Best of Us Investors presents Kerry Griegmeyer.
Kerry, my research indicates that the economic turmoil resulting from the pandemic negatively affected commercial real estate, particularly by leading to a sharp, albeit temporary, increase in delinquencies among commercial mortgage-backed securities. As the economy recovers from the pandemic, some commercial real estate owners with mortgages outstanding are continuing to face pressure from a decline in lease payments. Missed payments potentially jeopardize owners' ability to repay their lenders, many of which are banks. According to the Federal Deposit Insurance Corporation, FDIC, more than 98% of banks engage in commercial real estate lending, and commercial real estate loans are the largest loan portfolio type for nearly half of all banks. The commercial real estate market is large and complex. Most of the properties are owned or leased by private companies, so valuing the market is difficult. Banks are the largest lender of commercial real estate mortgages and hold around $3 trillion in commercial real estate debt on their balance sheets. Commercial real estate mortgages are financed on shorter terms than residential mortgages, often with balloon payments due at maturity, often 2 to 5 years. TREP, an industry analysis firm, estimates that $448 billion in commercial real estate loans matured in 2023, with about $270 billion of that coming from bank loans. In the office subsector, due to the convergence of work-from-home policies and other economic pressures, many companies that rent space from commercial real estate owners are not renewing their leases, and some are breaking their leases or trying to renegotiate terms. This is evidenced by higher office vacancy rates, which hit all-time highs earlier this year. A loss of rental income will lead to higher default rates among commercial real estate owners. This is compounded by the coinciding maturities of many commercial real estate mortgages, which will accelerate defaults if rental income cannot sufficiently offset the balloon payment obligations or if alternative financing cannot be procured. Banks hold $1.8 trillion of non-farm, non-residential commercial real estate loans on their books. Delinquency rates on commercial real estate loans peaked at 9% in 2010 in the aftermath of the financial crisis and fell to a recent low of 0.58% in 2018 before spiking briefly during the pandemic. While delinquency rates have risen again, they are still lower than pandemic levels. However, charge-off rates have already begun to exceed pandemic levels, suggesting that banks are writing down the values of their commercial real estate portfolios. Because the largest banks generally tend to make larger loans, this could mean that vacancies among large office and retail spaces are driving this trend. Regional banks tend to have a higher concentration of commercial loans in their portfolios compared to national banks. Regional banks often focus on serving local or specific geographic markets, and as a result, they may have a more intimate understanding of the local economy and the needs of local businesses. This local focus can lead them to have a larger share of commercial loans, including loans to small and medium-sized enterprises, commercial real estate loans, and other business-related financing. Here are the 4 largest regional banks that have extensive exposure to the commercial loan market. U.S. Bancorp is a large regional bank with a substantial commercial banking division, serving businesses across various industries. PNC Financial Services Group is a major regional bank that expanded its commercial banking presence through acquisitions. It offers a range of commercial lending solutions. Truist Financial Corporation was formed through the merger of BB&T and SunTrust. Truist is a large regional bank with a focus on commercial and retail banking services. KeyCorp is a regional bank with a presence in the Midwest and Northeast, providing commercial lending and banking services to businesses. Kerry, this is my analysis of the current commercial real estate mortgage landscape. If you're looking for a canary in the coal mine, I would suggest you focus on U.S. Bank, ticker symbol USB, PNC Financial Group, ticker symbol PNC, Truist Financial, ticker symbol TFC, and KeyCorp, ticker symbol KEY. I also want to point out that the financial repercussions and the potential reach of this problem is far greater than that of the 2009 subprime crisis, in my opinion. Add to that China's recent write-down of its residential real estate crisis, and this could have far-reaching consequences. Let me know if you need any further assistance.
Thank you, Adam. That's exactly what I was looking for, and I hope you, as a viewer, got some value out of this. And we'll go to Adam on the website and ask him any question you have relative to your investment portfolio or any questions you have about any element of financial planning. That's what I'm here for. That's what we're here for. That's what we're trying to do. We're trying to get ahead of the situation because I think the community as a whole is not aware that this situation is going to present itself and will create a setback in some of the euphoria that currently is wrapped around AI. I'm going to just touch on this. There is a bubble. Yes, there is no way that a stock goes up 50% in 2 weeks, and it's all based on things are great and everything's going to be wonderful. It does remind me of 2020 and the EV bubble. It does remind me of 2000 and the dot-com bubble. And those aren't the only 2 that existed. There are some that go back all the way to the invention of the railroad and the radio. We'll talk about that another time. But right now, avoid those 4 banks.